All right, well, it's 9:01 and let the festivities begin. And yes, I am wearing the Cousin Eddie costume. It's got the full dicky and everything. It's quite humorous. But as you all know, I like to go all in whenever there's some fun to be had. I am always there to have fun and do it. So in the spirit of Cousin Eddie, we are, 13 days away from Christmas. And we're going to hopefully get some Christmas good news, some Christmas presents here through the markets. So I'm just going to jump right in and share with you kind of what's happening in the markets right now. So bear with me one moment while I pull this back up. Get over here and share screen. All right, guys. Well, this is what's happening with the markets right now. Rates are flat the last couple of days. We're a little bit worse, basically because there's a bond rollover, but we're 30-year fix. We're right now at about 6.38. And again, that's the national average based on one scenario, 25% down, the perfect borrower. So if you have somebody that has at least less credit score or lower credit scores, whatever it may be, they may be higher, they may be lower with points, etc. But this is a good barometer kind of what's happening with the markets. 6.38. We have a big week coming up, and I'm going to get into it in just a second. So really exciting stuff that's happening this week. It's going to be very volatile. It's going to be exciting. It's going to be a little bit risky, but what we think is going to happen is going to really be helpful for mortgage rates. So I'm going to go ahead and start this right now. We've got rates, real estate, and wealth. That's kind of what we're going over today. We just went over rates. Rates are still in the mid to low sixes. The 2-1 buy down is still incredibly useful, and we can go over that in just a minute. But want to go over what's happening this week because we may see a lot of really exciting things happen. Well, we are going to see a lot of exciting things happening this week, and this is what's happening. So today, 11 o'clock, we have a 10-year auction that's going to be happening. Now, right now, the 10-year is right around the 3.5, and if inflation is coming down, that means the 10-year will probably drop as well and be worth less in the future. So if you're a bond investor, you may want to buy up a lot of 10-year bonds right now because they're at a higher yield of what compared to what they most likely will be in the future. So this is going to be a really good insight as to what the markets this week will do. So if we get a really strong 10-year auction, it's going to be bond people and bond investors kind of getting in front, knowing that inflation's coming down. Now, tomorrow is the CPI. That's a consumer price index. That's the big headline. I'm sorry, not the big. That's a big, exciting inflation numbers that should have a big impact on mortgage rates. So I'll go into my crystal ball in just a second. And then on Wednesday, the Feds are speaking, and they're raising the Fed funds rate by 50 basis points. Now, keep in mind, the Fed funds rate is not mortgage rates. They do impact credit cards, home equity lines, everything based on banking credit, but mortgages are bonds, and they're based on mortgage bonds, so totally different. And then on Thursday, we've got jobless claims and retail sales. So it's going to be a little wild week. Where I'm floating right now going into tomorrow, and I'll tell you why through my crystal ball. So here's my crystal ball. The CPI, the Consumer Price Index. That's headline inflation. When you look on the news, the headline for inflation is the CPI. That's what everyone really looks at. So it right now, year over year, is at 7.7. Based on my math and what the projections are for what the CPI is going to be tomorrow, we should have a reading, an overall reading of 7.3. So that's really good news. This is my crystal ball. And then core inflation, that's stripping out any of the food and energy, which the Feds really can't control. That's what they really, really love. This is their favorite inflation reading, is the core inflation number. That should drop from 6.3 to 6.1. So that's my crystal ball. Now, what does that do to mortgage rates? Well, it helps them. So here's my next crystal ball. Mortgage rates in the 5s. Now, this isn't going to happen tomorrow, but if you look at the charts, which we will in just a second, and we see inflation coming down to where their target rate is, we are going to see rates, mortgage rates in the 5s, the latest by March. Mark my words. That's with no points. You're going to see rates in the 5s. And then I'm telling you, there's going to be a little bit of a psychology switch that's going to happen with your buyers. It's going to be all over the news. People are going to come to you thinking that rates dropped. They're going to think they're going to went to 2 or 3% because they don't know. But they will drop. They won't drop into the 2s and 3s, but they will be in the 5s. Mark my words. So another thing I want people to think about, there's a lot of fear out there. A lot of people are saying, well, are we going to see homes be upside down again? Or is this is a bubble? I want to show you guys something. In 2009, 25% of homes were underwater. That's a huge amount. Right now, 1.9% have negative equity. And let me explain to you what that 1.9% is. Every single USDA, VA loan, when they fund, is upside down because it's 100% financing, and they roll in the funding fee, the VA funding fee or the USDA fees. They roll that in. So at closing, they are instantly upside down. Okay. And then FHA is 3.5% down, but they have a funding fee as well, an MIP that's rolled into that loan. So going into it, FHA, VA, and USDA are either underwater day one or they're close to it. So if you have just a 1 to 3% change in equity position, you can see how that number can show about 1.9% underwater. So I want to make sure you guys can explain this to the customers that think, oh my gosh, I'm going to wait for homes to drop because there's going to be short sales. I mean, I've heard this numerous times from people, and I'm just saying that's not going to happen. And then also 37% of all homes in the United States are free and clear. So tons and tons of equity. So inflation, I talked about inflation drives mortgage rates. Literally, inflation numbers and mortgage rates usually move parallel unless acted upon by an outside force. That's my physics for you today. So if you look at these modeling right here, back from 2017, we've got the 30-year fixed rate at the higher number, and we've got inflation, the headline CPI below it. Look how it moves in unison with it for the most part. And then we had what's called quantitative easing. They started it and then they went really all in middle of 2020, and they started buying billions of mortgage-backed securities, flooding the market with money, and the mortgage rates kind of went down, 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 and they kind of stayed here where the inflation numbers, they said, wait a minute, we can't sustain this. Inflation started going crazy and went up, but the markets didn't move with it because we were still artificially keeping everything low. And then at this point, they started saying everything's transitory, it's transitory. And then they saw that what they thought was the peak right here. And then they're like, everything's transitory, see? And then all of a sudden it wasn't peak. And then we saw that big spike. So now they're in unison again. After they stopped QE, they're in unison again, and see how they're coming up here, come up here. It's really easy to see what mortgage rates are going to be doing if we know what inflation is doing. That's why I can do that crystal ball so easily. And then inflation peak. Remember how I talk about last month, we had October come in at 0.3. It replaced a 0.6. So guess what? The overall inflation went down 0.3 because we replaced a higher number 12 months ago with a lower number of 0.3. And that's exactly what we're going to be doing for the next 3 months. If the headline comes in at 0.3, we're going to be replacing a 0.5 in November's numbers with a 0.3. And December, we're going to be replacing a 0.3, replacing this 0.6 with a 0.3. So we're going to be replacing high numbers with low numbers. So inflation numbers should be coming down. And what happens when inflation numbers come down? Mortgage rates come down as well. So if anyone says mortgage rates are going to be going up, the Fed's talking about it, they really are confused. They just don't know. And they're just ignorant. They don't know the details behind how mortgage rates work. And this is why I want to make sure you guys understand this, because there's no way I can talk to all my customers And I want you guys to be able to say, actually, mortgage rates are driven by inflation, and inflation numbers are coming down. So you expect mortgage rates to do the same. And then also, we're in a recession, right? They don't want to admit this, not everyone. And here, by the way, cheers to coffee with in my Moose mug. Sorry, a little comic relief there. And but rates always get better during a recession, always. If you look at all of the recessions, mortgage rates always get better. So we've got that going for us as well. So as you see, the numbers don't lie. Inventory, guys, people think the inventory is going to spike. How many of you had customers saying, oh my gosh, the market's going to be flooded, people aren't going to be able to sell, they're not going to sell their homes, or they are going to be selling their homes and they're not going to be able to sell, it's going to be tragedy, there's going to be too many homes on the market. A lot of people are predicting this huge flood of either foreclosures or just inventory. And yes, inventory is up, but we're coming off all-time lows. So look at it where it was in 07. And if you look at how many homes are built and how many households are being formed by people moving into their own homes or by population growth, it's easy to see how we still are having an inventory problem. I mean, look at when you're working with your buyers right now, the homes that are out there that are for sale, they're not the best. And those that are really good, they're still having multiple offers. I'm seeing that. I know you guys are seeing that on the really nice homes that are priced normal. We're seeing all of the buyers flock to those because they're already redone, they're nice homes, and they're having multiple activity on it, multiple offers on it. Just this weekend, we had a few that had multiple offers on it, and it's happening. So if it's a property that needs a lot of help, you may see those stay on the market for a while, or they may just be overpriced. So here's what the news is showing, guys. This is what people are like, oh my gosh, look at the inventory of housing going up. And in January, March, it's going up, up, up. But what they're not showing is the full pattern. And here's the pattern. This is the pattern of the amount of inventory and the cycle that we have. It's like the backbone of a dinosaur or an alligator. It always goes down and then comes back up in the spring and summer, down, up, up, over and over and over again. And look where we're at. We're right in this lower trenches again. And yes, is it going up? This is where everyone was saying, oh my gosh, there's gonna be too many homes on the market. And we leveled off and now we're coming back down. It's just the way it works. So when people are telling you that there's gonna be a bubble, there's just not enough homes on the market. And let's just face it, half of the population that has a mortgage or owns a home has rates in the 2s and 3s. If they don't, it's because they bought within the last couple of years, or the last year, I should say. But those people are going to think twice about moving. Anyone with a rate in the 2s and 3s is going to really think twice about moving within the town limits or city limits that they're in, knowing that they're going to get a rate in the 5s or 6s, like when they could have a rate in the 2s or 3s that they have. So a lot of people are coming to me with wanting cash out, wanting home equity lines to either add on to their home or make the home that they're in better, and maybe matching the home that they potentially would want to buy, but it doesn't make sense to get rid of a 2 to 3% rate and move to a 5 or 6% rate. It just doesn't make sense. So that's why inventory is still staying low as well. On top of the fact that we've had an inventory shortage for a while, just because builders stopped building. So here's active listings in the USA. It's still quite low compared to where the average is. Even back in 2017, we are ridiculously low. So that's going to continue to drive interest rates. And guys, investors are continuing to buy homes. Excuse me. If you look at the Blackstones, the major investors out there that are buying real estate, they're still doing it. And when others are buying those homes with cash, and other people, I would say normal humans, not investors, are trying to buy primary residences and they're gobbling up everything, there are some conspiracy theorists that think that in the future, who knows how long, most of the homes are going to be owned by corporations. There are some people talking about that, and the trends show that that very could well happen. It's going to be extreme if it does, but they know that they can make a lot of money on housing, and they're smart. And so a lot of people are looking at investments and thinking, okay, well, let's look at that, because if they're doing it, why can't I do it? So there's a lot of people that are investing. And with that being said, the net worth of the people in the United States is very interesting. So the top 1%, the net worth is 10.8 million. And this is net worth, so equity in your homes, that's all part of it. The top 2% of the United States has 2.5 million in equity. The top 5% has 1 million in net worth. 10% is 0.8 million, and the top 50% is $500,000 in net worth. And check this out, 2/3 of the net worth in the United States is home equity. So if anyone ever comes to you and says, you know what, housing doesn't make sense, it doesn't make sense to buy, renting is perfectly fine, and then you can invest other places, 2/3 of the United States net worth is in the form of home equity. So it does make sense to invest in real estate because a lot of people are doing it and it works. So here's a real estate for wealth creation. In 2016, if you invested in a $300,000 home with 10% down, that's a $30,000 investment. Think about that for a second. $30,000 investment. The home's worth $300,000, but you only invested $30,000. So Case-Shiller says we're up 72% since then. So right now that home is worth $516,000. That's a $216,000 profit over the $30,000 that was invested. That's a 720% return. These are the numbers we need to be showing people that are interested in real estate, because you're not putting all of the $300,000 in it. If you're a cash buyer, yeah, you are. But when you're getting a mortgage, you're putting a lot less down. And keep in mind, you still have to pay rent if you're not investing in real estate. Excuse me. Here's another one. In 2019, just a few years ago, if you put 10% down, that's a $40,000 investment. Case-Shiller, we're up 48% since then. That means that house now is worth $592,000. That is a $192,000 profit, a 480% return. Remember, it's based on the $40,000 you invested. You now have a $192,000 profit. So real estate makes sense. Anyone that says, should I buy or should I rent? We have some really great tools for you. If they're contemplating renting, we can put together a rent versus own and show the difference. Now, up front, it may look like it makes sense to rent versus buy, because you're going to save the cash flow difference. You're going to save a little bit more by renting. And this is where everyone stops. Everyone stops right here. They're like, see, look at this chart. It's cheaper to rent. Well, rents go up. You're not paying any amortization when you rent, but you are when you buy. So your amortization gain, even though it's negative cash flow, is $41,000 over that time period. And compound interest, eighth wonder of the world, appreciation gain is $193,000. So overall, you're actually, and your tax benefit. Sorry, I forgot to put that in there. So the cost to sell, let's include that as well, right? So that's $36,000 roughly. And now your total net gain over a 9 or 10 or 9-year period, which is the average a human stays in a home before they sell or move if it's a rental, $205,000 net gain. So we can run these all day, guys, to help motivate your buyers. It's called the rent versus buying. If you need these reports, let me know. I'm happy to provide them for you. Now, here's the housing forecast that everyone's looking at. So a part of it is forecasting, okay, if I'm going to rent, or if I think I'm going to rent, I need to know what the housing is going to do. So low single-digit appreciation is what everyone's thinking. That's the 3 to 5%. And then rents are going to continue to rise. Currently, they're up 13% on new rents and 8% on renewals. So if you take all of this into consideration, it makes sense to buy. Now, we have a new tool. It's the investment property analysis. And 1 out of every 6 transactions right now is an investment property. So if you're not helping investors buy homes, you're missing out on a pretty big sliver of the industry. We have a tool where we can do an income property analysis for you. And basically, here's some basics on it. Purchase price, let's just say it's 500. We're putting 20% down. Let's say the rate's 7%. They're going to own it for 9 years. We take into account the costs of the transaction. And at 7% today, that's with 1 point. So there are some costs on that. The average monthly repair, annual tax increases, the cost to sell, appreciation of 5.1%. We're taking this into consideration. Vacancy rent, we're looking at $3,500 in rent. The rental increases. When we put all of this together, we now have a cash flow analysis. We have a 1-year cash flow, but keep in mind the amortization you're paying, the income, the expenses. We take all of that into account. We have a 9-year cumulative cash flow at $36,000, all of the expenses, the rental income, and then we cash flow it out over the time period. And that's a cash on cash return of 31.9% if you look at this full schedule. So I can put these numbers together. Don't get too dizzy over these numbers right here, but it takes into account everything. If you have investors that want to look at what it looks like to buy real estate as an investment over time, this takes into account everything. And I can put these together till the customer's blue in the face. But it takes that, it takes cash flow, it takes appreciation gain, it takes amortization gain, and then it goes into your full equity and full profit over that time period. So you can see exactly what your net worth is just by purchasing real estate. So if you need these reports, I'm happy to run them for you. They're easy for the customer to understand when we put them together because the numbers don't lie. And if it's a savvy investor, they'll really catch on to these. But these reports are going to be very helpful in helping you. So a lot of people's belief systems are skewed. They think they don't look at the numbers, they don't look at the facts. So we need to stop them, give them the information that they're really looking for, and help them. Now, another thing we have, you may not know this, we have our own AVM model and that we can put together for you. So if you're going on a listing presentation, or if you're going to talk to somebody about potentially buying in the area, we do have AVMs that we can put together. They pull in all of the comps of the neighborhood, and it's a really neat little format. So if you need something like this, we can help provide this for you as well. It gives everything. A lot of really good information for them to look at. Also, the real estate report cards, guys, don't forget about our real estate report cards. It gives everything for the neighborhood, the employment for the neighborhood, what the unemployment rate is. It talks about the forecast of that neighborhood, how many households are moving into that area, how many are being formed, really everything for them to really see what exactly is happening with their markets. I mean, it's the reports are really, really great. But I want you guys to walk away today not knowing that I kind of look like Cousin Eddie and I've got my moose cup and everything to match, but to know that we're excited for next year. And you should be too, because mortgage rates are going to be better. They are going to be in the 5s. Mark my word. Share this with everyone. I will fall on my sword if I'm wrong, but I know I'm not going to be wrong unless something crazy dramatic happens. We are going to see rates in the 5s before you know it. Before you blink, they will be there. So every buyer that you have, you need to reach out to let them and just have a conversation with them. Say, okay, if rates go into the 5s, would you entertain buying again? And even put together a what if. Okay, if you're buying this house today and the rates were 5, the payment would be right about here. Would this get you back into the market? What if we were to do a 2-1 buy down when rates enter the 5s and your first rate was in the 3s again? Would you do that? If your first year, your interest rate was at 3.5%, would you buy today? We need to start having this conversation because I promise you this March is going to be kind of crazy. Almost every buyer that we've worked with that was on hold over the last 2 years, they are all telling us that they're going to be going back into the market after the new year. Now, if we have an inventory shortage and rates are lower and all of those people on the fence come into the market at the same time, what do you think is going to happen? I mean, it's kind of makes like sense that, yeah, it's going to be a little bit competitive for buyers. So common sense would say it makes sense to look right now before that happens so that you can get in without all the competition. Because like we're seeing right now, like this month, we're seeing numerous homes that are really good with multiple offers. If everyone's back in the market again, what will that look like? I hope it gets crazy again, but not I do not wish anything upon what happened in the early 2021. That was nuts. None of us slept, but it's going to get more competitive. And you can always refinance your rate. But if you were to go into a home and maybe get a little bit less on purchase price or get a buy down now and closing costs paid for compared to having to go full price offer with no concessions in 6 to 7 months, which buyer is better off? So I need you guys to have that conversation with your buyers that are on hold. It may be a really good time to enter in the markets right now. So rates in the 5s, that's a nice little Christmas present for us. This week is going to be very important. So 11 o'clock today, we're going to see how that 10-year happens. And then the Feds are going to be talking. And what the Feds say this Wednesday is going to be very important. They will raise the Fed funds rate by 50 basis points. People are going to think all of the rates are going up. So you need to let people know that it's okay. Mortgage rates may come down. In fact, they most likely will. So hopefully there'll be no surprises on the inflation numbers, but we're expecting them to come in at 0.3, which is going to be lower than the 0.5 we're replacing, which means lower inflation, which means lower interest rates on mortgages. So there's your Christmas present early for you guys. It's going to happen. And I'm even posting this on social media. So I am very, very, very confident. So if you guys have any questions, if you have buyers that have questions, I would be happy to do a conference call and show them exactly how it works, because a lot of people think they do. They think they know, and they don't, because they just don't understand the details. So I'm going to open this up for chat. I see there are a few questions. You were the funniest holiday guy I know. Thank you, Angie. I appreciate that. As you know, I like to have a lot of fun. Where do we go to see what those numbers are? I assume you're talking about the inflation numbers, Carla. You can just look up CPI report on Google and you'll see that. Consumer Price Index, CPI. And where can you find out how many homeowners have rates below 5% in Arizona? So the deed is public knowledge. We can see the deed of trust that is recorded against a property, but we cannot see the note rate. So really the only way to know who has rates above or below 5% is going to be when the deed of trust was recorded and figure out what the average rates were at that time. So if you're looking at people that were closing, let's just say between now and April of this year, you can pretty much guarantee their rates above 4. If anyone closing since July of this year and now, guarantee they're going to be in the 5s and 6s. So that's really the way of really understanding kind of where people's rates are. But it's weird. I mean, I don't know where a group of people were back in the 2020 and 2021, but there's still people with rates in the 6s, 7s, and 8s that never refinanced. It's crazy. I don't know where they were, but they still come out. That's why you still see some people refinancing. But refinances are down 90% since last year, and mortgage loan applications are down 48% since this time last year. So overall, mortgage lenders are down 75% in total volume. And that's why you're seeing a lot of mergers, a lot of companies going out of business, and a lot of pain in the mortgage industry, because they hired a tremendous amount of people at the peak to handle all of the business that was happening on refinances, purchases, and that just 75% of that just went away. So what does that tell you? 75% of the staff is potentially has the potential of being taken away. So the mortgage industry has gone through quite a bit of change over the last 6 months. So be friendly to your mortgage people. They may be drinking heavily this holiday season, but we're good here. We have a very solid company, and mortgage companies and the how solid they are is very important. So we have literally billions because we are backed by a bank. So we're a mortgage broker, we're a mortgage banker, and we have a banking partner that our parent company owns. So we've got a tremendous amount of power and stability. So that's always good for you. It's good for your customers. And that's part of the reason we are here. So Any questions on what's happening with rates? Any questions on what you're hearing from your customers? Any issues that you're seeing with builders? Oh, and with builders, keep in mind, builders are kind of desperate. And if you have something in contract, under contract right now, they're kind of giving away the farm if your borrowers are a little aggressive with them, saying, hey, that rate's too high. I heard rates are lower. If they've already locked, they're willing to kind of give away the farm right now. And I've seen it happen numerous times. So yeah, it's if you have any customers that are locked in with a builder and they locked their rate a little while ago, I would have them call to renegotiate that rate. I saw the movie Spirited last night. Felt like I was. Yes, I've got a face that kind of is like a chameleon. Some people say I look like a lot of different people, so that's pretty funny. I have not seen that movie Spirited yet, but it looks like a lot of fun. All right, guys. Well, I think you guys really need to focus on, and me including, calling all of our borrowers that we've had for the last 2 years, making sure they know what the future is going to look like to get them ready. Because I'm telling you, after this New Year's, a lot of people are going to hit the ground running and they're going to get back out in this market, and they need to be prepared. You need to coach them on what it may look like if there's a lot more competition, and to be willing to go out and start looking now. Any questions on what's happening with interest rates? Any questions on those reports that I can present to you? If you have any investors that need that report, I'm happy to put that together for you guys. Who's excited to have rates in the 5s? Thumbs up. I know about 3 people have their videos on. Well, I'm actually going to be going to the snow, so I'll be up at the cabin this week. I'm sorry, next week, and I'll be back in the office here, but I will be working through the holidays if you need anything. Most likely we won't be doing a Monday morning meeting next week. So if you need something, I will be available, but we're going to be probably pretty lean because that's the Christmas week. And if you guys need anything, please do not hesitate to reach out, and please get excited about what mortgage rates are doing, because it was a little scary there for a little while. And we'll really watch what's happening this week in the markets, and hopefully expect to see rates in the 5s before you know it. So that's really, really good news. And maybe the 4s, who knows? We'll see where this roller coaster takes us. All right, guys, looks like I covered everything. There's not any questions. So have a phenomenal week, and we will be here to support you with whatever you need.